When analyzing any stock, there's two things that we want to know up front. First, what does a company do? And then how do they make their money? So when you think about what Shopify does, imagine that you needed to sell a bunch of products online and you didn't know where to start. Well, not so long ago, there was a lot of people peddling this idea of being able to achieve financial independence by building a drop shipping site. So what you would do is find somebody with a large product catalog, and then you would connect an e-commerce site to their product catalog, and people would order products from you, and then they would ship directly to your customers. So it was a way for people to quickly establish a storefront, but what most didn't think about is the fact that they had to support those customers and that it isn't all that easy uh, as it sounds on the tin. So a lot of people got into drop shipping. You see here some uh, ads that were floating around. One says, "How much money do you need to start drop shipping on Shopify?" And the reason that they mention Shopify is this is the largest e-commerce platform in the United States. They have about a 30% market share. Most merchants that use this platform, they're paying less than $50 a month. So it's a way to get your feet wet in the world of e-commerce. And the company focuses on providing cost-effective solutions for early stage businesses. It's very accessible. So when the coronavirus happened, a lot of people moved to buy things online, and then a whole different contingent of people had a lot of time on their hands, so they decided to start businesses. And this is the easiest way to start an e-commerce business. It's very accessible, very affordable, and they've worked out all the kinks. So when you think about Shopify being an e-commerce platform, that subscription model is how they started. Now, when we look at the performance, their share price, it's down 76% year to date, and that's kind of typical for growth stocks. That's compared to a NASDAQ return of about minus 25% over the same time frame. So a number of readers and subscribers had asked, is Shopify a good stock to look at? Well, when we look at how they're making their money, there's two revenue segments that we need to pay attention to. The first is subscriptions. That's what we talked about. That's about 28% of their total revenues. And look at that gross margin. So it's upwards of 93%. They're making a lot of money on that solution. But when it comes to growth, it's growing slower than their other segment, which is merchant solutions. So we talked about subscriptions. We understand how that works. You subscribed and you access their e-commerce platform. But then once you're a successful merchant, and imagine that most on their platform aren't, then they get you with merchant solutions. So this is a growing percentage of the revenues. It's lower margin, still high though at 60%, and a growth of about 7.5%. Both of those growth numbers were taken over the past 8 quarters, so the quarterly growth. Now, to understand the merchant solutions segment, they want you to pay attention to this gross merchandise value metric, which they provide, and it's liberally slathered all over their slides. And this is correlated to the success of that segment because it represents the amount of money going through their platform. So successful merchants are selling a lot, and when they do, people pay for those products, and there's a Shopify payments processing piece that collects fees based on daily transactions. So that's quite lucrative. That's they say, the largest component of merchant solutions. But when you say largest, that means nothing. It could be 11% and the rest could be 10% or whatnot, right? So you just don't know what percentage of merchant solutions is Shopify payments, because they're also talking a lot about things like Shopify Capital, Shop Pay installments, Shopify shipping, fulfillment, which they've been getting into lately with the acquisition of a particular firm that we're not going to talk about today. And then there's this Shopify Plus, which is a more extravagant subscription model. It's somewhere in the 2K range for larger businesses. So right away, we're interested in knowing more about merchant solutions because that's where all the growth comes from. In particular, we're interested in the money that they're loaning merchants. So when you start to dig into their financials or you look at their latest earnings report, they talk about how $416 million has been funded by Shopify Capital for merchants this last quarter, up 15% year over year. And that so far they funded $3.8 billion in cumulative capital. That's about all we know. There's another metric in their income statement that shows losses. It's called transaction and loan losses. And here we've plotted that out as a percentage of merchant solutions revenues. You can see that it's spiked. So we're very interested in understanding more about that. Unfortunately, this company gives us no granularity into that large segment of revenues. And when I say no granularity, there's almost nothing there aside from the monthly recurring revenue number they call MRR and this GMV, gross merchandise value number, that they throw around. So we're really hurting to understand how exactly they're making money in merchant solutions, and that really matters. Now, what makes things even worse is that their earnings, this is a Canadian company, so they may be doing things differently than how firms might report in the US. Certainly their filings are different, so you have to contend with that. But take a look at the earnings reports here, and you'll notice this is quite odd. You have what appears to be over $1 billion in earnings, positive earnings, in the third quarter of 2021, and suddenly that starts falling. And then look, this most recent quarter, they had a loss of about $1.2 billion, and before that, a loss of over $1.4 billion. What's going on? Well, when you look at their books, they've made a couple very large equity investments, and one of those is in Affirm. It's a buy now, pay later company, and we've always warned investors about BNPL because it doesn't require the firms that extend that credit, doesn't require them to vet anyone's credit. And the argument is, well, the AI algorithms do a good job of being able to tell who's able to pay back. Well, that doesn't consider that you have lots of BNPL vendors out there extending credit, and a lot of individuals are taking advantage of that. And you can look on social media and see the people that are weekend millionaires with all the cheap tat, or expensive tat that they've purchased through BNPL arrangements. So Affirm has certainly been punished, and focus is starting to be placed on the quality of the credit that they've been extending. So when you look at these two equity holdings on Shopify's balance sheet, you can see that they've collectively lost 75% of their value so far this year. That's not a big deal. That's what tech stocks do. It's just a shame that they're reporting that in earnings so that you don't get a real good picture of what's going on. You have to back those numbers out. But that's probably the biggest problem here, is that it's obscuring how you view their quarterly results, and it takes extra time and effort to understand what they're actually doing with a firm that's already very difficult to follow. So we don't believe that an investment in a BNPL firm is a very good idea. Now, when we look at the valuation of Shopify, they're not overly valued. They're right alongside Robinhood. Maybe you could say they're still a little bit rich compared to some of these other fintech names we've listed out here. So it certainly has room to move downwards. But the big problem with Shopify, the consistent theme in looking at this firm, is just how bad investor relations is. The latest quarterly earnings deck, it looks like some interns went around collecting statements from each department, and they kind of just splashed those all over some slides. There's not a single chart in the entire deck. It's very amateur. It's very poorly put together. And that's a concern because it makes this firm very difficult to follow, and you want to invest in companies that you can understand and track easily. So for example, how do we find out about geographic concentration? That's pretty basic, a pretty basic item we looked for and couldn't find. You have customer concentration, number of customers, revenue buckets, who's paying what, Shopify, this premium Shopify Plus, how many customers do they have on that? What are retention rates looking like? None of these metrics are given. There's no granularity in that merchant solutions segment. So just to conclude, the two key metrics that you have to watch, this GMV and MRR, that's all fine and dandy, but it's not enough to gauge the health of the company. And these equity investments they've made obfuscate their earnings. And in a recession, what happens? You have a lot of small businesses hit the skids, and small businesses are what Shopify caters towards. We're not told otherwise. We're not given any indication of the size of the companies that they're working with, but you will see small businesses go under and you will see consumers curtail their spending. So this isn't a firm that we'd want to have exposure to in a bear market, especially given how opaque the entire business is. So put your comments in the comment section. Make sure to subscribe to our channel. Thanks for taking the time to watch this video today.